Welcome to the next presentation of simplified ERP-based business analytics. As you saw in the introduction video, our key solution is based on significantly improving a range of business processes across the industry. As part of this initiative, one of the first key processes that we have addressed is credit control, and we would like to run you through our key credit control appliance. As we all know, in any organisation, the credit control department is the principal contributor towards maintaining a balanced working capital. An efficient credit control process significantly minimises bad debts and results in a financially healthy client base. A minimal bad debt also positively impacts the receivables register, producing an improved working capital flow that fuels intended sales. With this in mind, the importance and sheer scale of this process is considerable, to say the least. It is an absolute necessity to get this right first time, and, unsurprisingly, the process isn't without its own challenges. A few of these key challenges in achieving an effective credit control process are the ability to establish actionable context between outstanding debt and the collection process with the customer's payment behaviour in mind, to minimise the bad debts by correlating customer payments to sales, and simplifying when it comes to quickly creating useful and intelligent information for insight to actionable analysis. This is where you would turn to your complex ERP system for the required answer. Whilst established ERPs like Oracle, SAP, or MS Dynamics do offer a few important standard reports like aging trial balance by buckets and debtors, credit management reports, and customer summary and payment receipts, they are only able to generate them at a very restricted manner. Additionally, when it comes to actual insight into your data, these systems offer limited capability for any drill down or slice through analysis, as there are very few evaluative tools and methods incorporated into these systems. What's required and missing is a dedicated intelligent analysis workspace, offering a much needed integration of these important functional data points, combining them to offer an insight to action framework, forming the foundations towards a strong business process improvement. An actionable insight framework is built on the idea that the mountains of data your business generates can be infinitely more useful to you when it's doing more than just being collected within your ERP system. In fact, the industry is in desperate need for an appliance that can give you more options than just the standard data dump. What's also required is a system that would integrate data from multiple source systems and present it in a way that employees of all levels can take away the maximum amount of value from it. Key does just that. Each data point generated within your business is intelligently integrated with the others to become useful information. From here, that useful information is transformed by applying respective business rules and combining multiple data sources to generate the required knowledge about the key areas and the glaring gaps. This knowledge is then processed through a few highly scientific, mathematical and statistical algorithms to provide the business with valuable, prescriptive foresight, enabling them to make the most impactful actions towards an effective business process improvement. With an innovative engine underneath, our key credit control appliance is absolutely business focused and highly practical in addressing immediate business needs in an intelligent manner. It also plays a vital role in the business, driven by two strategic objectives: improving the immediate working capital management by reducing the outstanding collections, and improving the operational productivity of the credit control process as a whole. Let's look at two of the many possible ways where Key enables you to turn this data into useful information, developing knowledge and extracting value to offer you actionable insight. For a daily operational use of the Key credit control appliance, let's open the dashboard. As a credit controller, we can instantly see our total receivables along with other major KPIs. After reviewing these figures, your credit controller might see that your overdue receivables are at 13 million, which is 11% of the overall receivables figure, and way above the target of 4%. They check the DSO gauge and see that it too is above its target, showing a value of 75 days. With these troubling statistics in mind, the credit controller can then check the overdue buckets to see how far back the overdue invoices go. Whilst it appears that the majority of these invoices are only overdue by less than 1 month, a worrying amount are past their payment dates by much longer, ranging from 1 to 3 months overdue. With this knowledge, the credit controller can double check these figures for any legitimate delay, such as invoice dispute amounts. Shifting their gaze to the right hand side of the screen, they can see that these chronicled disputes make up only 500,000, and therefore cannot account for the complete overdue amount. Now, with confidence that the only reason for not collecting this money earlier is down to the customers with these invoices, the credit controller can view the table below disputes to see who the top 10 customers are for invoices overdue by 2 to 3 months. This gives them the immediate list of customers to be pressured for payments by collection agents. One of the final steps the credit controller can take is to go to the Reports tab and select the Detailed ATB option. This will instantly allow them to see which collectors are holding the most of that overdue money to their accounts. Essentially, a complete picture and ready-made list against each collector. Additionally, any external issues with collectors, such as absence due to sickness, vacation or otherwise, can be remedied by redistributing their accounts through your ERP to the other collectors available. Further still, this report can be easily exported to Excel for internal use, or if the collector cannot access the system or is based remotely, then this information can still be distributed to them with ease. There we have an easy, useful and informative way for a credit controller to look at the data or apply the insight to action framework for an operational use. Now, let's take a look at a tactical approach to using the credit control appliance. For a credit controller, knowing your immediate financial position at any given time is a basic requirement for the industry. As standard, records your company keeps enable your credit controller and their department to compare the financial position now with that of an earlier date, enabling you to show growth or other trends in certain statistics. What the industry lacks is a more accurate forecasting for your future financial position, enabling your business to make more tactical moves based on more accurate information. As you know, your DSO, or Daily Sales Outstanding, is a measure of how long it would take to reclaim all of your current receivables based on the average amount of money you collect per day. Therefore, to maintain a steady DSO, you obviously have to maintain your average collections. This isn't as simple as it seems, as there are many factors which will affect your collections, most of which are completely out of your business's control, ranging from employee absence due to illness or vacation to the unpredictable nature of your clients themselves. You might think that to obtain the ideal collection rate, you have a set collection value for the year and you simply divide that by the total months or by weeks to give you a repeated target for each week, respectively. It's obvious that in any business there are good days and bad days, and this leaves your actual collection values rising and falling past their targets respectively, leaving your business hoping that by the end of the period they balance themselves out. Whilst this unpredictable strategy might work for some businesses, there are inherently a large amount of stress that comes with it. To alleviate as much stress made by these problems as possible, this key solution calculates the collections your business needs to make in a slightly different way, from the ground up. The simplistic algorithm incorporated is based on a simple question: what is the collection amount your business has to make month by month to retain that steady DSO? Whilst this may appear to be the same basic strategy, where other businesses get the month-by-month collection value from the total, Key asks another question. What is the most likely collection total you'll make this week? By using your customer payment schedule history and your business's past collections, Key can use this specialist algorithm to provide you with the most realistic weekly or even daily collection list from your customers. And just like that, the stress of consistently hitting weekly high average targets evaporates, because you know that all the levels of your new targets are both achievable and reliable. This knowledge now provides your credit controllers with the tactical advantage of a more reliable foresight of your company's financial position, enabling them to make more informed recommendations for the business. There's just two of many ways this key solution improves the credit control process. If you'd like to know more, please give us a call and we'd be happy to help.